Hi, everyone. I'm James Garbutt.
And I'm Denny Dumas.
And this is the Garbutt Dumas Real Estate Podcast.
Alex McFadyen of Thrive Mortgages, one of the most knowledgeable men in residential real estate financing. Welcome to the show, buddy. Thank you so much for joining us this fine Tuesday morning.
We're happy to have you, Alex. Thank you.
Well, gents, thank you for having me, and what a kind introduction. Thank you, Denny.
A lot has changed in our industry in the last couple of weeks. Have you ever seen anything like this?
Every call I make, it's like, hey, what's happened lately? What's changed lately? Well, let me look back at my last 2 hours.
Yeah.
I'll let you know.
How long do you have here?
Oh, I've got a solid 30, 35 minutes this morning, guys. So we got lots of time to talk about this. But
no, I meant like on the phone when clients are asking you, what's changed? Your response is, well, do you have a couple hours?
Well, when I spoke to you 1 week ago and the rates dropped a half percent, since then, let me just break down a chart of what's happened. We actually, funny enough, in that timeline have built out literally a chart and 6 videos to explain what's happened in the last 2 weeks, and we're working on a few more because it's quite literally difficult for a lot of people to comprehend it in a phone call. So you have to visualize it, get it out to them in that way. It's like, if you're an existing variable rate mortgage, what does that mean for you? If you are a fixed rate mortgage, what does that mean for you? What if you're new? What if you're renewing? What if you're stretched out? So we've got these different categories that we're trying to address at this point.
That's one of the cool things for us following you, and you're kind of inspiring us, is just, to me, I see you in the residential mortgage game as the industry leader in terms of providing value and educating clients throughout all of these changes. And you're doing a phenomenal job with all of that content that you're putting out right now.
Thank you, sir. Appreciate that.
And just to kind of recap, I was one of those guys that phoned Alex and said, hey, what's happening right now? Yesterday. And the moment I said, wait, why is, when the bank rate goes down, why are rates, mortgage rates going up? And I love your comment. Well, I could go surface with you. This could be a couple hours of explaining it. But I mean, overall, aside from that convo, you have been a source of information for us. We were talking on our previous podcast prior to this, is these are great opportunities to become that trusted authority. And when it comes to lending, you're spending a lot of time doing the research. You have a podcast, you have a very active social media, Instagram. So you're putting tons of videos and podcasts out there. And you're basically providing us with updates, and you've become an authority for us. So it's nice. One, I think your business is going to be better for it after this because of it. But two, it's nice that we have one extra source that weeds through and filters through all the information that's being released and puts it out there for us in a simple way. So thanks for that, Alex. Keep it up.
Appreciate you saying that. I mean, the goal, just like you and what you're doing right now with your podcast, is there's quite literally so much information out there to get. And there's a lot of traditional mediums, the news, obviously a lot of fake news with Facebook and Instagram and what you see out there, a lot of reposting of articles without an explanation as to what's going on. And so my goal is to take a lot of the information that's out there and break it down to people into what do you need to know and what does it mean to you in as many different mediums as possible to get to people first and forefront. When we started doing video, I'd say about 5 or 6 years ago, the goal was to educate people as much as possible. I think now it's gone to not just educating, but also informing. And the purpose in starting a podcast is partially passion, but the second part is to inform and educate and let people make their own decision with that advice. You know what I mean?
Absolutely. Mm-hmm. Yeah, and I think you kind of struck a chord with me when we were chatting that one time, and you mentioned your goals are measured in how many families you help or how many people you help, not how many mortgages you close. And so a podcast is lining up right in line with that. You're adding value to people's lives. And that's the goal, that the process is add value, help people, and the business will come. And I love that.
Appreciate you saying that, guys. I know we're aligned in that space. So one example of that, if you're not doing it already, and anyone who's in the industry who's listening to this right now, we're a heavy base purchase team, meaning a large percent of the business that we do is helping people purchase homes, purchase investment properties, and otherwise. So with what's gone on in the last few weeks, particularly in the last week, we have seen a notable drop in that type of business and inquiries about that type of business. And for a lot of people, that would cause a high level of concern. And don't get me wrong, there's obviously some sidestepping that we had to do as well. But in that last 2 weeks, the one thing that we've noticed is by going back through our clients, our existing clients and the people that we've served and people that have been helping right now and having conversation with these people, they trust us very heavily and they're okay to listen to us and talk to us and hear us. And they want this type of information and feedback. And I truly don't believe if we took the approach of here's your mortgage, here's your rate, I got you good terms, et cetera, and then called them up and said, hey, do you want to refinance or something of that nature? They're not going to respond quite as well as if, hey, we give them a phone call after we provided with a video or a breakdown and information and had a clear conversation about how are you doing? These are the things that have happened right now. Here are the ways that we could take advantage of that. Why don't we discuss your particular situation? And having those phone calls have been phenomenal. And so our business hasn't dropped. We've just changed where the business is coming from and the way that we're supporting these people. And I think that's where, again, just speaking to industry people who are in that space, whether you're a real estate agent or a mortgage professional or a financial planner or whatever it is that you do, is just finding different ways to focus on the value bringing to people and be intentional about it. And it does come back to you.
Absolutely.
I think that's something that you, Alex, though, in the last few years have just you're at a different level than most in our industry. Most realtors are not providing video content explaining how changes are happening and then following up with phone calls and finding the best outcomes for people. So I think even just you outlining that quick process of how you go about helping someone refinance or whatever that may be, I think that will be a big eye opener in terms of what sets apart the elevated people in our industry versus the average numbers.
I think that the way that people make decisions now is based on understanding information or going to the source to understand the information and then making a decision based on how they feel about that. And what I mean is, if you think about the last time, we talk about reviews and how important it is if you're booking a hotel or, we're not doing that right now, but a flight down to Mexico and a resort, what are we doing? We're jumping on TripAdvisor, we're understanding the reviews, but more important, we're also looking at different types of parameters and comparing, visual elements on websites. And then we might actually pick up a phone and call someone and ask for advice. Which is interesting because we still want to talk to a human in the way, I don't want to name any companies, but there are some companies out there who still have advisors and they're still thriving in this environment. In the real estate industry, I think it's very similar, but people are slow to adapt, which is provide the information, provide the value, help people get to the source and give it to them. And then be available for when they're ready in the way that they want to be there, which is what you're doing right now with your podcast, with your videos, with your communication style, is provide the information to your clients, make sure that it's independent, it's unbiased, and then follow up with them to be available when they're ready to make that decision. And that's where we're going in the industry. And that's why I think that on our team, although we have had to make adjustments, although we have had to make changes, we haven't had to lay anyone off. Our business volumes have not changed dramatically. And we're I hate to say it a second time, but we're thriving right now in this environment because we're still helping people in that same medium, right? I'll try not to plug that too many times, guys. I'm sorry.
We should plug this. Why don't you share the name of your podcast just so people know how to stay in touch with you?
Yeah, so a lot of people are having a hard time with this one, so we might end up changing it. But for now, it's called the YVR REMO Show. That's short for Real Estate and Mortgages. There's another podcast out there with a similar name, so we couldn't take that one. It was already taken right now. But the YVR REMO Show is what it is and where you can find it. We typically go on once a week, and our goal is to share current events similar to what you're referring to. But we take a lending-based approach, an advice-based approach. We have had on people that are talking about wealth planning and investments, and hopefully we can get you guys on with boots to the ground and just take a little bit of a financial perspective on what's happening and break it down in easy to understand language. So if you're in the industry or outside of the industry, you can really get an understanding as to what's happening at that time without falling asleep. That's the goal.
Yeah, and just to add to that, for people to get a hold of you or watch what you're doing, Instagram handle. I know Mortgage Pug, but which one do you want people to look up after this episode?
So I have a fabulous team and partners. So Thrive, Instagram.com/Thrive Mortgage Co, Facebook.com/Thrive Mortgage Co. We're live on Facebook or Instagram almost every single day, along with 3 to 5 videos and content every single week. The Mortgage Pug, that's my previous moniker. I'll call that my personal brand. That one, that's my brand that I've had now for a few years, and my affinity for my dog and making mortgages a little bit less boring. But I realized that I couldn't call my team a group of mortgage pugs. They just weren't into it. Some of them have pit bulls and French bulldogs, and we couldn't make that rhyme very well.
Love it. Well, but so as the listeners are gonna, we're gonna dig into this and come up with our crystal ball of where the future's going. But if you're a listener and you just want to kind of ignore the noise and just have a local trusted lending source of information, those are great follows. Just ignore everything else in the world and trust that Alex and his team are going to just give you the goods. But let's get right into it. Let's get right into it.
Yeah, let's do it.
Denny, where do we start?
Let's start with interest rates. I know there's been so many changes, so maybe just give us an update on the most recent half-point deduction in the Bank of Canada rate, what that means for consumers. I think banks announced over the weekend or today or yesterday that they are following suit and lowering their prime rate as well.
So let's split this up into two conversations. Okay. Let's talk about the variable rate and prime and the Bank of Canada and what's happened there. And then let's have a separate conversation about where interest rates are as a whole at today and why they went up and down. So I think the first and most important thing for people to understand is that there's two different factors, and there's hundreds of factors at play, but two overarching factors that we're going to talk about. And the first one in particular, guys, is, as you are aware, what we call the Bank of Canada key interest rate, or commonly known in the lending space as prime, or in the real estate world as prime. Those two items those two factors are just so commonly miscommunicated and confused. And what we try to do in our space is explain who's actually impacted. So going back now, let's go back about a month ago. The Bank of Canada, with seeing what was happening with the coronavirus overseas in Italy and in China, and actually, if you listen to my podcast in the start of February, we talked about this. What happened was, in the financial markets in the US and Canada, people started pulling their investments and putting it into safe investments, such as the Bank of Canada bond yield, which ultimately is one of the levers that impacts fixed rates. Now, on the variable rate side, we saw that what was going on, the bank was already forecasting, or the government of Canada was already forecasting to say this could have negative implications in our economy. So they were already foreseeing this and seeing what was happening with less product being shipped over to Canada and less I guess basically our economy was in a little bit of a stalling place, where what happened is, in order to stimulate the economy, they dropped the interest rate, the key interest rate, by 0.5%. Now, when that happens, just to kind of bring it back, when that happens, we see banks often follow suit, and that's prime. So prime dropped 0.5%. So that helped everybody who was in a variable rate mortgage right away, or a line of credit. Now, what's happened since then is, obviously, Trudeau's been speaking every single day, and we've seen where things have gone since then. And we've not dropped 0.5%, we've dropped another full percent in the following 3 weeks. So within a month, we've dropped 1.5%, the key interest rate by the Bank of Canada, which has meant that the banks have followed suit, which has meant that variable rates and lines of credit and everything have dropped 1.5% overnight. And the biggest consideration here is not necessarily just the residential consumer that's listening to this right now, but it's also for the businesses. So the bank is really trying to stimulate the economy and keep people borrowing as much as possible, and getting the banks to be able to push out that money as much as they can. So that's kind of the breakdown, I should say, of prime and where it's at today, guys. Does that make sense? And is that kind of a clear breakdown?
Yeah, just to recap, prime was at 3.95 basically for all of 2019, and now it's at 2.45. And the fixed rates that we may not have mentioned this, but say 2 weeks ago ish, you were doing a big push on suggesting refinancing and renewals because fixed rates were how low were they? The 5-year fixed?
Yeah, so we saw the fixed rates drop by almost 0.75% in a week and a half. And they went from what was typically about ranging from 2.95 to 3.29. It dropped all the way down to the low end of the lowest we saw it hit was about 2.19, ranging on the high end of 2.59. And that happened within 1 week.
That is cheap money. So
yeah, and that's where that bond yield comes in.
Right? Is that safe to say?
1 week, maybe a week and a half is how long that lasted.
It was open. Okay. Yeah. And I, there is no short answer to this, but the question I had for you yesterday was, why, when the prime rate goes down, are fixed rates going up? And you mentioned the cost of money, essentially, or was that basically like the highest level of it, or am I butchering that?
Yeah, no, you're getting the right point. So prime and the fixed rates aren't necessarily completely tied, although you do see them to some degree come up and down.
There's a correlation of some sort, though, right?
To some degree. What is mostly based on is the bond yield. The 5-year bond yield is where we normally see fixed rates go up or down. And so we saw that bond yield go from a bottom of almost like 0.5%. And normally you'll see about 1.5% spread between the low end to the high end. So somewhere between 1 to 1.5. And it jumped all the way up to almost 2% overnight. And so the reasons for that, again, is there's a lot of reasons. So again, we can only go so deep here. But first and foremost, risk. The reason that rates went back up is the banks were seeing a high level of risk. How many consumers are losing their jobs or potentially going to be losing their jobs? How many people are trying to defer their mortgages right now? What is the risk that people may foreclose if the property market goes down and now they're spending their time and their energy trying to sell off properties at a loss potentially, and on and on and on. So risk is a big factor. And the second one is money. The banks were running out of money. Everybody and their dog was trying to refinance their mortgage to take out some equity to either have a contingency plan or consolidate their debt or renew early to take advantage of these early interest rates. And the banks don't like that. Contrary to popular belief, they don't necessarily want that because they're churning their book, if you will. Mm-hmm. And so when they're seeing this, the other factor they're looking at here is people are now draining their bank accounts. They're spending their savings, their checking accounts, or at least they're predicting they will, to make these payments, to make this rent because the EI hasn't kicked in, or there's not enough money, or they're focused on paying off their car loan and their other debts. And typically, that's where banks get the cheapest money to lend you. So you stick your money into your TD or RBC bank account, into your savings or whatever, and they're paying you maybe 0.5% or less, and they're taking that money and they're lending it back to you at 3% above that and earning money on that. But now there's less money to draw from. So rates go up because it's a shortage.
So when you're saying there's less money to draw from, but at this moment in time, we have all these programs of loans for businesses, where are they drawing that from? Or is this getting too complicated for your world?
I think we're getting deep, but I mean, I can only guess at this point right now, the bank has a lot, the Canadian bank and the government has a whole heck of a lot of money stashed away, and they have access to a large amount of capital and money that they can draw from in the world market. So they can supply those funds if necessary to small businesses. And that's what they're doing right now. And on our side as business owners or as a residential owner of a property or just generally someone who lives in Canada and pays taxes, we will be paying for this for the rest of our lifetime, for sure, in the form of taxes. So if you're wondering where that money comes from, that's taxes. And that's where that's going to continue to go up. But I think to continue on your previous note about the prime rate, just to address that really quickly, the Bank of Canada's prime, you've seen the discounts like for the last 2 years, as we saw the prime rate actually go up, we saw discounts of between prime minus 0.5 to prime minus 1. So effectively 0.5% off to 1% off the rate that you saw from the bank. Now those discounts have all but disappeared. So today I was looking at my emails and I saw prime plus. So prime plus 0.1 was one of the better offerings to Scotiabank advertising prime plus 0.25, right? So we went almost a full 1.25% swing now on the interest rate. So while prime is great, it's incredible. If you're in a variable rate mortgage, like kudos, you made a good decision. Stay there, don't move. But if you are looking to get a mortgage today, don't expect to get the same discounts you saw 2 weeks ago.
Right.
I didn't know that had changed. That's a good point, actually.
So what I'm suggesting to my clients from a strategic standpoint right now is you don't have to renew today, right? And you're not in the position where you have to make a decision today. I'm suggesting still consider a variable rate mortgage because given where things are going and have gone over the last few weeks, we are likely to see another big swing down and up in the fixed rate market. And it's completely subjective to what happens in the next month. But we could see fixed rates come down again. We could also see the Bank of Canada cut prime again. So even if you do have a prime plus 0.1, if the bank cuts it again another 0.25%, you're down just over 2% in a variable rate mortgage, which is a good place to be.
One of the big differences between this market crash and the 2008, 2009, back then it was due to credit crunch, the banks defaulting on loans. So they tightened credit. This time it seems like it's just, aside from fixed rates going up a little bit, but they're still historically very low. But it just seems like banks are throwing money out there. Is it like, in terms of a credit cycle, are we at a state where are we? Is it going to get tighter in the future, or is that it? Could it get looser before it gets tighter?
Well, I mean, James, you've been doing this for quite some time, and Denny, you've seen a fair amount now. So we've seen a couple of different types of cycles in our space. We've also seen a series of big mortgage guidelines come in, and I won't get too deep into that in the last 5 years, but let's go back 10, maybe 12 years when the first quote unquote cycle hit in 2008, 2009, which was the first major tightening of our system after watching what happened in the US. We can't technically have the same thing happen in Canada as to what happened in the US. We've always been a lot tighter, and we offer insurance behind mortgages to protect the lenders. But with that being said, credit is getting substantially tighter, and it has been for years. So this is nothing new to me, but I was just talking to a borrower yesterday who's going through the process of buying a home, and he actually hasn't applied for a new mortgage. He's just done renewals and just signed the paperwork. But at advice from his friend who worked with us in the past, he gave us a call, and you wanted to look at some different solutions. And after strategizing, we talked about the series of documentation he would need. His mind was just absolutely blown at what we needed before we can do anything. It's getting to the point right now where traditionally a bank or a person at a bank would just input information, pull a credit report, maybe ask for one or two items and submit the file. And now the underwriting centers on our side and the bank side, which the bank side is usually more relaxed, they're asking for every document or as many documents up front before they will even touch a file. So for our business, the way that we run our business, we ask for all documents up front. That hasn't had any major impact, but it is having an impact across the board for other borrowers who are getting either declined or frustrated about the fact that banks are completely tightening up and being substantially more closed with the money they're lending out. If a year ago, we'd see exceptions for maybe their debt to income ratio was a little bit too high, meaning they couldn't they could get a little bit of an exception to borrow a little bit more. Today, we're not getting those exceptions at all. A client hasn't started their job, but they're an RCMP officer. Sometimes we can get an exception where as long as they start their job right before closing or right around that time, we can get them qualified. Substantially harder to get those exceptions today. So everyone is tight right now.
So banks are highly concerned about risk, even though rates are lower. The fear is default on mortgages, or the fear is risk. I think
the fear is the unknown, to be honest with you.
Yeah. If you now, I don't want to spend too much time on this credit stuff, but have you ever watched or are familiar with the Ray Dalio credit cycle video?
No, I haven't seen that.
Anyone listening, Google credit cycle, Ray Dalio. It's a 30-minute video that is very helpful at explaining how that world works. But anyway,
right now,
let's Denny. There's been more changes than rates. Next one.
I want to quickly, this is what we obviously in the real estate side of things are getting a ton of questions on is mortgage deferrals and how those processes look, or what even are the steps to apply for a mortgage deferral and what are the terms involved. So can you just touch on that? I've gone through personally with a couple different lenders, Westminster being one, Scotia being another, and their programs are drastically different. So I think just understanding that each lender is going to have a different program. Applying for it is as easy as just calling and waiting on hold because the lines are extremely busy right now. But putting your name down and then you get a call back. Scotia or Westminster is the one I've heard back from, and their program is a 2-month deferral in the way of a line of credit. They're setting up a line of credit for you, interest free for 1 year. And so basically your mortgage payments just go into the line of credit and you pay it off as you wish, but it'll start accumulating interest after, I believe it was June 1st, 2021.
I think just what you brought up right there just shows where things are at in regards to the deferral program. These companies, these banks are making up these programs on the fly. This isn't something that they had previously. And the feedback that I've received right now is that the programs are almost still changing on a daily basis, where I had someone I did a mortgage for 2 weeks ago go into court, basically isolation or quarantine on themselves immediately. And as soon as these items were announced, reached out to their bank. The feedback that I received from this person day one to another person that I spoke to yesterday, working with the same lender, was drastically different in what they asked them to do to qualify and what they were allowing. In this case, without naming the lender, because I don't think that's important at this point, it wasn't a typical bank, if you will. Originally, it was one, maybe two payments that can be skipped. You have to fill out a spreadsheet, and you have to show that you're either A, not working, or you're facing some form of financial hardship. And then yesterday, the client I spoke to said, no, now it's two, maybe three skip of payments, depending on what happens. And they just asked them to write in an email a summary of what's going on and what they were looking for. So it seems that these policies are changing almost on the fly. I've heard from people that, called into Scotiabank 2 weeks ago where they were told only on your primary residence. And now today they're allowing it up to 4 properties that you own. And it's almost black and white. You can defer for anywhere between 3 to 6 months, depending on your hardship and what happens here. And so I think, you telling me about the line of credit piece has been pretty standard. I've heard that now from a few people that the credit unions in particular are focused on basically putting a second position line of credit. It's important to keep in mind they can only do that for people who have enough equity in their homes. So for people who don't have equity, they're generally people who have bought with less than 5% down. They're using a CMHC guideline, which essentially does allow up to 6 months for qualified applicants. So I guess the point here, every lender has a different policy. It's not black and white, and how you're going to prepay that is going to be different. I do suggest our clients just consider the advantages of doing so, as opposed to going, if you're somebody who bought your home 2 months ago at 5% down and you've lost your job, apply for it all day long. Take it if you can. You don't have an option to sell off your property. You're probably going to lose money. You're in a position where you could, have missed mortgage payments, which is not ideal. Then you would want to go forward and apply for that right away. But if you're in a position where you're still functioning, you're still working right now, and maybe you have some other outstanding debts like car loans and other debts that you've probably needed to take care of for a long time anyways, this is where a consolidation in the short term might make more sense, and you might even be declined for the program anyways. So I think it's just understanding your personal picture. But I mean, what's the worst case scenario right now? You're basically deferring money at 3% interest, which is going to be compounded, but it's better than paying 20% on a credit card. The only key consideration here, and I will just put this out there, and there's been a lot of communication on this, is will this impact your credit? Will it not? The banks are saying no, but there was a similar situation which occurred at a much smaller scale in the Fort Mac fires and the whole mess that happened up there a few years ago, and it did impact credit, even though the lenders were saying it wouldn't. So I'm hoping that it doesn't, but we'll have to wait and see.
So just to kind of recap on that, I mean, the suggestion that I'm hearing there is, if you're affected by this COVID situation financially, great to take advantage of it. If you're not as financially affected, long term, you're going to just pay more interest and financially be worse off. Is that? I mean, obviously, if you're deferring interest, you're building up more. But what would be?
Well, I think this is where we would look at someone's personal financial situation as well. Like, this is why we want to have a conversation, right? Because let's put it this way: a lot of the people that we've talked to that have asked about it, that actually have, a lot of these people are still working right now, and it's kind of more of a proactive ask when we're reaching out to them. They have credit cards. Like a gentleman I was talking to yesterday, just running down his account, he's got $18,000 in credit cards. He's got almost $50,000 in an unsecured line of credit, and he's got a truck loan. All these debts that he's paying are above 9% interest. So if he defers his mortgage payment right now, he's deferring a payment at 3%, but he's still having to pay all those other debts at 9, 12, 18% interest. So while he's working, in my opinion, if he has the equity, it might make more sense for him to consolidate those debts at a 3% interest rate. And then if he loses his job, he can defer it later on. That's something that we're looking at and recommending for a lot of people, and that's something that would make more financial sense. So it's a case by case scenario, really.
What are you suggesting right now? I totally understand your logic. If someone is coming close to due on their mortgage renewal, or whether they're 2 months out or 2 years out, what is your suggestion right now to that individual for refinance or renewal?
Okay, so we're talking about somebody who's coming up for renewal, right?
Yeah, let's say they have a 3.3% rate, or I guess it obviously depends on their current rate, whether they do anything or not.
Yeah, I'd say the big thing right now is, given what's happening in the marketplace, I'm likely going to suggest to someone to consider the possibility of taking either a short-term mortgage or a variable rate today. And if they have time, get their ducks in a row, get your documents in, get your application in, get your file, submitted for what makes sense today. And we'll proactively watch the marketplace. But the reason I'm suggesting to consider the variable rate mortgage is because, again, we might see another drop to prime, and it could be years before we see a recovery here. In addition to that, if things change, in most cases, you can lock, if the fixed rates drop down, you can lock into whatever the fixed rate is at the time that you want to convert. So let's just use an example where someone dropped in today at prime plus 0.1. So they'd have a 2.55% rate. We went down 0.25%. That puts them at 2.3 tomorrow. I mean, that's a pretty nice place to be, right? Let's say, 3 to 6 months from now, fixed rates drop again, and we're down another 0.5% at, say, 2.3 to 2.4%. If they felt like at that time they wanted to lock in, they could convert at no additional cost, or they could switch at a low cost. The maximum you'll prepay on a variable to get out of it is 3 months of interest, right? So I'm suggesting people be open to the variable rate mortgage right now because of that flexibility and because of what we're dealing with right now. If it goes on, guys, for another 2 to 3 months, this could last for 1-2 years. The economic impact of this, right?
Absolutely. That's, and I think in the US it might be worse. That's a lot of unknowns south of the border.
I'd love to hear from your perspective, guys, to turn it around a little bit.
Yeah.
What are you hearing your buyers? What are you hearing from them? What are they talking about when it comes to buying a home on the lending side? What are their biggest concerns and questions, and what kind of things are they bringing up with you?
I recently had someone who is waiting for completion. So they bought a place in January, I think completes end of April. And I got a phone call from them the other day. They bought and sold at the same time. Their biggest concern was, I guess they had heard in the media a couple times that banks were pulling lending due to someone losing a job or their financial situation drastically changing in between subject removal and completion. So their biggest concern was, is my sale going to complete because I need this completion to purchase the home that we have a firm contract on?
Man, that is a scary proposition, isn't it? If you're in that position,
Totally.
You've just sold your property, you've put a deposit on the home of your dreams, and then you're in a position where you might not get it because you lose your job a week or 2 weeks or 3 weeks before funding. I've been asked that question so many times recently, and I'm glad you brought that up. I think the reality is, I'm hoping that most of these banks and institutions use common sense, although I can't say that they always do that. We did deal with a situation just under a week ago where a client did get a call back from their bank before completion. I won't name the name of the bank, but they did get a call back, and the file was canceled at the bank because both parties were no longer working, and it didn't fit their parameters anymore. So we did have to find a backup option for this client at a higher cost, which was unfortunate. Since then, we did have one bank in particular publicly state, and this was Scotiabank, that for anybody who had their purchase complete, their subject removal, and they've got their conditions all accepted with the bank, if they're completing before September 30th, they would use a common sense approach, and this client would still likely fund, assuming they were in a safe position beforehand. So that's nice to see, and I think we'll probably see some other banks follow suit. But that deadline for that bank was actually March 27th. Anything after March 27th, they said there are no guarantees that they would honor the system anymore. So I guess that's kind of like a warning shot out there to people to say, like, if you're in a position where you might lose your job, don't apply for a mortgage right now. Although I'm hoping that they still keep some common sense. My suggestion for anyone in this position is don't not look for a home, but just know your backup options and have them available to you just in case something happens.
Totally.
Now, Alex, how much time do we have for you? Just so we can. How much time do you have?
Boys, I got another 10 minutes here. If you want to keep going.
Cool. Yeah, let's keep going.
Jamie, would you prefer to chat about the tenancy rule changes or go into small business stuff and payment or employee payment subsidies?
Let's touch on the tenancy rule changes because I think that's valuable for people that, even if it's not necessarily Alex's world, let's just touch on that. So, Denny, how about you?
So my understanding from last week's announcement was that basically landlords, for most reasons, can not evict or provide notice to end tenancy in the next foreseeable future until this health concern is passed. So what that means for someone who owns an investment property or has a basement suite in their home who is thinking of selling or is currently on the market is that you can no longer provide vacant tenancy in the next few months anyway until this passes. Have you had much info on this, Alex?
Guys, I just got the announcement and I was looking through it yesterday. I haven't dug in really deep as to where that's going to go, but I was actually, and I don't tune in a lot to the general news stations, but I was this morning. And what I was watching was an article where the renters union or a tenancy union, I'm not sure the name of it, was actually asking that the government the BC government steps in and eliminates rental requirements altogether. Now, I feel like that's a heck of a lot bigger than the BC government, and that goes a lot bigger than any of us at this point right now. I know you gentlemen have investment properties or rental properties, and so do I. And we're very fortunate in the position we're in, but I can't imagine that going on for 2 to 3 months for many of the clients that we have who are landlords, and many of them, even with a basement suite, they need that to make their own ends meet. So that would have such a domino effect. I don't even know what the outcome would be at this point right now. I think it's a wait and see approach. We're approaching the first month where rent is due April 1st. And I think we're going to find out in a week or 2 weeks what this is going to look like.
Mm-hmm. I think.
Are you hearing anything different on your side?
I hadn't heard that. So they're basically, that conversation that you listened to was basically saying renters don't need to pay rent for the foreseeable future.
That's what they're suggesting.
Wow, interesting. Yeah, that would absolutely have an effect on tons and tons of people.
Oh, there's a lot of news these days. Early days, it's hard to kind of comment on. I mean, some people are going to be in a real, like landlords are going to be in a real tough situation. Some tenants are not affected by this, so it'll be interesting to see what they do. The fact is that we're in a world where people are affected differently, and we're in the very early days of this, and this could frustrate some real estate deals. If there's some deals that went solid or firmed up in the past few months that had tenants in place and required vacant possession, what happens there?
So as long as notice has been provided, that's the way that I heard it. As long as notice has been provided as of the announcement, which was last week sometime, it still stands. But moving forward, like if you're currently on the market with an investment property, you have a tenant in there, I think that's why I wanted to just bring it up, is that make sure you understand that you could potentially be in a tricky situation and not be able to provide vacant tenancy.
Well, so I was talking to someone yesterday, an agent friend of mine who was in a position where this property had an accepted offer months ago, and the tenant is flat out refusing to move out today. I didn't get too deep on it, but at this point right now, that person's refusing to move out, and Tenancy, I guess the government or whoever's looking after having these conversations with them at this point, is agreeing with the tenant and not with the purchaser of the property. They cannot evict them right now. So these people are not moving out, and there's no way to evict them, and there's no way around that at this point right now.
That's tough. Yeah, it's the residential tenancy board that I think mostly protects the tenants in this situation, and obviously in times like this, there's probably a lot of people vulnerable. So I get the intent there. It's just unfortunate if people take advantage of this that aren't affected by what's happening right now. And that will probably happen as well.
That's what I think is going to happen. And the thing about this that I find interesting, and you guys could definitely help chime in on these points, is most of the people that we see are not big, giant, multi apartment building landlords. Most of them are pop and shop, owners of a few residential properties trying to make their own ends meet and build their financial future, that are getting negatively affected by this, right? I mean, and most of the guys that we work with and ladies who we work with who own these properties are just trying to do good by their tenants. They're trying to offer all solutions. They're reducing the rent when necessary. They're trying to help out. And thankfully, it appears common sense is playing out in a lot of these situations. But for how long is my question? At what point does a tenant just get frustrated and do something unfortunate or anything of that nature? And I think we need what I'd like to see is the common sense approach from both parties, not just the residential tenancy board, but to protect the tenant, but also protect the landlord, remembering that these are in most circumstances working people as well, trying to earn an income, but also trying to house people. And I think that's where personally, I get frustrated a little bit watching and listening when we see such a bias to say only the tenant can benefit this, but not the landlord. And what are we doing for them to help them, right? And I think that's why having the $500 or whatever the sum is makes sense for the time being, because then at least the landlord has the ability to take a portion of that rent and cover their cost. Because we have to keep in mind, there's still strata fees, there's still taxes they're going to have to pay, and in many circumstances, $500 won't even cover both of those, right? So it'll be curious to see, in my opinion, what happens in 30, 60, or 90 days. That's when we're going to see things get interesting.
Especially not knowing whether, first of all, if investment properties qualify for the mortgage deferral, but how long is it going to take for those deferrals to actually kick in? So like if a landlord has to float a mortgage and property tax and strata fee for even like 1 to 2 months, it can be very difficult on a lot of people.
Yeah, I can't imagine what that's going to look like. And I think we're going to see a lot more come out in the next 1, 2, 3 weeks when it comes to these deferrals. And I'm hoping to see some other options from the landlord side of things. Very difficult to advise our investment clients with so much unknown right now. But we're just trying to preach patience and common sense with your tenants and just recognize that everybody's going through a hard time and we need to work through this together.
Sure. One other thing I'll just add to this is when you think of like the condo investor landlord, and a lot of times they're just regular people stretching themselves to get an investment. But when you think of the typical condo landlord, they're now dealing with insurance crisis. They're dealing with stronger tenancy rules. It's with all the things that have happened in the last little while, it leads me to believe that that's a less appealing investment moving forward. So it may impact the appeal of buying your typical condo investment in the short term until things change.
Well, this coupled with what's happening with the property insurance, don't forget about that. I got an email yesterday from a landlord who owns multiple properties in a building where we're having those insurance issues come back again. Those testy little insurance problems that we've seen, where the insurance is not going to be enough to cover their costs. So this altogether could be an interesting proposition. So that's going to do. Who knows what that looks like, guys? You tell me. Is that going to reduce condo prices? Is that going to reduce rental properties? Like in general, if we don't have mom and pops purchasing 2 or 3 condos to rent out, does that mean our rental supply is now reduced as well? Because then rental rates go back up again. So what does that look like?
Well, I definitely want to get into predictions here soon, Alex. I want to. that's where we're going to roll into. But before we get into the predictions of what that's looking like, I think I'll share one like interesting comment, because I saw a note from like a counselor in New West, and when you see, when you see what governments are doing to kind of reduce people's bills, this friend of mine in this note mentioned that cities like New Westminster can't waive people's property taxes or they'll go bankrupt. So there's certain, like Burnaby, very financially strong city. So every city's in a different situation, but a lot of cities can't do much to help the people. Like, so on a city level, there's not much that can happen. But I just wanted to add that because I thought, when you see what government's doing, let's see what the city's going to throw in as well, but they can't do much. Otherwise they'll go bankrupt. Well, I'd love to roll into predictions here while we have you for a few more minutes here. So, when you're looking at all the factors in your world of lending, when you look at all the factors that are going against the real estate market, and you look at all the factors that are going, against the real estate market in terms of prices going down and the forces that would cause prices to go up, where is your head at with the real estate market in, say, late summer, fall, maybe this time next year? What are you thinking right now, Alex?
So I think obviously we have to put a little asterisk in there and say that it's going to be subjective to how long lots of asterisks. I'm going to throw asterisks all over the place along here, because it's going to depend a lot on what happens going forward and how long this lasts. If this lasts for another 30 days, I think we see a little bit of a waiting time where maybe we have some people trying to offload properties and prices are relatively low, and then we see people jump right back in. People have a short memory in a lot of situations, especially when they have to move, because for a lot of people, moving is not a choice, but also something they have to do, right? So we're going to see real estate likely, I would say, a little bit of a drop, and then a hockey stick right back up if it doesn't last long. If we're talking about 3 to 6 months, your guess is as good as mine. It could take a lot longer for people to jump back in. It's going to, interest rates are at artificial lows, and we're not seeing that pump any juice into the market right now. So what does that mean if they stay low going forward? Do people just think this is the new norm and it doesn't get them excited? Are we seeing people have to foreclose, and who's taking advantage of that or not taking advantage of that? I quite literally don't know that I have a prediction for 3 to 6 months down the road if it takes that long for things to normalize. It would be more likely that we would see a kind of a slow growth state, in my opinion, just my opinion, because I think people would be just shy to make a decision, because we'd be back to, what was it, 2018, if I can recall, to jumping into 2019, where things were in a wait and see approach. Let's just see what happens. Let's just see what happens. Let's just see what happens. And then end of 2019, people are like, okay, it's been a year and a half. Let's do this now. We know what's going to happen. We know where we're at. Could we see another 6 to 12 months of that? What do you guys think?
Well, here, let me share my thoughts, because I put a few predictions out there. It's probably more appropriate to just call it a guess, because it is a what if situation. But the number one thing that I look at when I'm kind of putting my thoughts out there is supply and demand. And on a macro level, like on the highest level, real estate market will be affected by this. But there are many markets in real estate, and if you put them all into one category, you're including, West Vancouver $10 million homes with a $500,000 two-bedroom condos on the SkyTrain line. So when I look at the products that we often sell, the typical condos and entry-level homes, that supply and demand line is very different than what I think is on a macro level across Canada. And so when I'm looking at the forces that cause prices to go up, one, our market was trending upward prior to this. Two, we have low interest rates. Even for first-time buyers, the stress test has been alleviated a little bit. And we're coming off a very slow year. So there should be, when I look at the supply and demand curve, I feel that the demand is at a level that is, last March was the slowest March in 33 years. And so this March with COVID is probably, I don't know the latest stats, but probably not much worse, or even maybe even better. But the demand, due to low interest rates, due to people not buying last year, due to the thought that in our markets, I'm feeling that there's a lot of people that want to either buy their first home or upgrade. There's people not living where they want to live. That's what I feel is going to hold the market. And also the fact that our international dollar has gone down. So in theory, like, the value of $1 million home in U.S. funds has gone down 10% in the last few months. So if you're selling $1 million home today on international U.S. money, that's now a $900,000 home. So arguably, we've already been hit from outside markets. So, when you look at the potential of, foreign investors coming in, recognizing that, Vancouver looking like an appealing city in a pandemic, those are some positives that could keep the demand high. But on the supply side, what's going against that? Fear. People, if people see this job loss, how many businesses are not going to return? How many people are not going to get their jobs back? How are debt levels going to look? How many defaults are going to happen? And if the supply loosens up, I feel that it probably won't loosen up in the next 3 to 6 months. Maybe it does in 6 months. Maybe the fall's loose and supply outweighs demand. But I feel that, when I look at all the factors that are pushing both ways, in supply and demand, the demand's still there in the short term. And so I think if we're going to see sort of a downturn in the real estate market, like on the macro level, it might happen right away. But on the micro level of our market, it may never happen, or it'll probably lag a little bit. And it will probably lag, and it'll happen after a few months. My thought is because the economy's gotten significantly worse and fears there, and the seller supply loosens up. So anyway, that's my rant. But when I'm saying that, what comes to mind for you?
Man, that was good. That was really good. That was really interesting to listen to. And I think the outside factors you really well explained in my opinion. Just understanding what you're referring to in the outside money coming to Canada. We also have to keep in mind that this quote unquote pandemic is hitting the U.S. a lot more. So it could lead to a lot of our U.S. Counterparts wanting to move back to Canada or own in Canada, which is considered maybe safer after this. You're right. Man, there are so many factors to consider. I think we could probably chat about this one for an hour and a half.
Well, we don't have much of your time left, but I would be curious to know your thoughts on defaults. Like, when I'm looking at what could cause the market to get much worse? And to me, it would be a loosened supply, which often can cause by defaults on loans or fear. So fear due to job loss and poor economy, or like fear, job loss, poor economy, and then that coupled with defaults on loans. Do you feel that there's going to be a wave of higher risk loan default period coming up in the future? Because I remember, I think when people were buying in 2016, 2017, some people were saying, 2021 is the year where those mortgages come due and people are going to be in trouble. Are there any sort of periods of time coming up that could trigger more default?
I think this is going to push it back a little bit, what's happening right now. And I think this is awful timing from that perspective as well, because the government was set to announce different stress tests for potentially renewals, people who are renewing, as well as obviously buyers getting to the market, which were both pushed back and are not on the table right now. So just in case anybody's wondering, the stress tests that were announced about a month and a half ago that we're going to loosen some rules have been pushed back. We don't know when those will be reannounced. I'm having conversations like this. Jamie, thank you for asking. It's a good question. I'm having conversations like this from borrowers left, right, and center right now who are up for renewal this year or next year who did not have the stress test back, at least, when they were putting down 20% or more, or the refinance stress tests were not in place in 2016 or the first half of 2017 when they got their last mortgage. And I do certainly believe we will see some negative implications, especially if these people are looking to consolidate debts and they're shocked by the fact that needing to qualify at a higher cost of borrowing at 2% above the interest rate in order to get this refinance, to consolidate this debt. It's not as easy as it used to be. And this is already shocking people right now on a daily basis, especially as lenders are tightening up and some credit unions and other lenders are starting to shutter their doors for the short term. So yes, this will have an impact. What we're also seeing on the private lending side is obviously private lenders, who are usually the backup plan for a lot of people. Some big names out there like your Alpine Credits and Capital Direct, and there's many small names. I mean, our company works with some direct capital lenders as well. Some of these lenders are actually pulling back what would be considered to be their loan to value in anticipation that we will see property values decrease, and they don't want to be caught like they were a few years ago with property values being so high. In addition to that, the investors, the people who are investing in the mortgage funds, are also getting nervous and emotional, and they're pulling their money. So a reduced amount of funds is going to potentially increase the cost and reduce the backup options for people. So yeah, we might see a heightened amount of defaults. Again, Jamie, I think this really just depends on how long this goes on for, but my biggest hope for optimism is that this only lasts a few months, 2 to 3 months, and we can move on in a relatively short amount of time. My biggest fear is this lasts for 6 months, and like you mentioned, job loss is extreme, and I think there's a lot of jobs that aren't going to be hired back, personally.
Oh, I can agree with that. I know a number of entrepreneurs and business owners that have been affected by this, particularly in hospitality and events. And I wouldn't be surprised if certain people change careers after this. There's certain industries that are clearly exposed to pandemics, and when you look at how hard the catering companies work or restaurants work to make a buck, I mean, is it worth it when you can lose everything after a 6-month pandemic? Anyway, I know we don't have much more time. Denny, anything else you want to add there?
No, I think we can let Alex go. That was honestly, Alex, that was really great. Thank you again very much for taking the time to do this. Continue with your content game, because as we mentioned early, we are getting a lot of value out of it. So I'm sure there are tons of other people that are following along every day, even if they don't say anything to you.
Gentlemen, I really appreciate you both having me on. Thank you for doing what you do out there. It's refreshing, and love following along what you guys are doing. So I hope everybody listening to this make sure to subscribe to your channels and stays tuned as we watch your quote unquote adventures. Keep up with the fun photos too, boys. All right, gentlemen, thank you so much for having me on, and we'll be in touch very soon, I'm sure.
Amazing.
Cheers, Alex.
That's a wrap, Denny.